Good afternoon and welcome to today's webinar, Main Street Lending and Economic Update for Mid-Market Companies. Before we get started, I would like to take a few moments to go over a few housekeeping items. My name is Eric and I am the webinar organizer for today. We want to make sure today's presentation is extremely valuable for you, so we ask that you submit all questions by clicking on the question button in the control panel and typing your question there. Right now, please join me in welcoming Yvette Ito, President of Cleveland Development Advisors and the Executive Vice President of Finance and Operations for the Greater Cleveland Partnership. Thank you.
Thank you, Eric. Good afternoon and welcome to today's webinar, Main Street Lending and Economic Update for Mid-Market Businesses. I want to thank BakerHostetler, Novogradac, and Brown's Gibbons Lang for partnering with the Greater Cleveland Partnership on this webinar. Today's topics will cover the CARES Act legislative update, which will include the Main Street Lending Program. We will also cover various business tax provisions in the CARES Act and provide a capital markets update. We do want this webinar to be as useful as possible, so we are asking that if you have questions at any time throughout the webinar, please submit your question by clicking on the question button in the control panel. We do have a Q&A section at the end of the webinar, but if you could please include your questions as soon as you have them, that would be great. So our expert panelists today include Nathan Ware, who is a partner at the law firm of BakerHostetler. He's a member of the firm's business and tax groups and serves as the leader of the firm's development finance team. He focuses practice on tax planning and structuring of tax-advantaged investments. He also has vast experience with state and local government incentives, and he presents and writes regularly on a variety of tax credit issues. We also have Megan Murphy, who's a principal at Novogradac, which is a national accounting firm that provides public and privately held national and multinational enterprises with audit, tax, valuation, trust, and litigation support, and general consulting services. Megan serves as part of their national tax practice, and she has extensive international and corporate tax background. She's been active in Novogradac's work with the Opportunity Zone industry and is currently heading the firm's efforts to provide guidance around COVID-19 related funding and incentives. Then we have Anthony Delfrey, from the Managing Director of Brown's Gibbons Lang. He leads the real estate advisory team, which has closed more than $1 billion in real estate transactions. Anthony has over 27 years of experience in real estate and consulting, working with corporations, endowments, and high net worth individuals. His extensive investment background and his distinct expertise in tax credit transactions. So we're going to get started. I'm going to hand this over to Nathan, but again, just before we get started, a reminder, if you have questions, please submit them. Click the Ask Question button on the control panel. Okay, Nathan, I'm going to just hand it over to you.
Thank you. And Yvette, as I'm going along, if I get difficult to hear, just shoot me a note and I will try and speak louder and more clearly. Advance to the next slide, and I will quickly start here with a legislative update. And this is very, very real time. One more slide forward. The Paycheck Protection Program and Healthcare Enhancement Act was signed into law on Friday. So it really cruised through Congress in the matter of a week, and then again signed into law on Friday. I think probably a lot of the impetus for that was that the funding for as I call it, the Triple P program, Paycheck Protection Program, ran out on the 16th, and there was just a lot of pressure to appropriate additional funds for that program. I will note that Ohio did seem to do really well. I jumped on the SBA's website, and they have statistics as far as how each of the states did, and based on my review, it looks like Ohio was number 7 in both the dollar amount and number of loans. So I thought that was pretty cool. Anyhow, the Enhancement Act appropriated and authorized an additional $310 billion to the PPP program. I was on the SBA's website over the weekend, and according to the site, the SBA resumed accepting applications today, so the 27th, at 10:30 this morning. So for anybody who is interested in applying but hasn't yet, now would be the time. The other thing that I'll quickly note is that as part of the Enhancement Act, they set aside $30 billion for community development financial institutions, so CDFIs, to make these PPP loans, which I think is great for nonprofit borrowers and smaller borrowers that maybe don't have relationships with the big banks. So in addition to the funding for the PPP, the Enhancement Act also provided an additional $10 billion of funding for the Economic Injury Disaster Loan Program, the EIDL loan program, and then finally another $100 billion for health and human services, $75 billion for hospitals and healthcare providers for COVID-19 related expenses, and then 25 for testing. And I know Anthony and Megan are in the weeds, helping lots of clients with PPP, so would be interested to get their thoughts on the program and this additional pot of money that is going to be available for more loans.
Sure, Nathan, I'll jump in. So further in the deck, and we don't have to hit on that now, we have spent quite a bit of time at the epicenter of the PPP loan program. I would say for our sector was the hotel owners and operators and borrowers that candidly did not have any time for the revenues to drop off. They dropped off as a function of the stay-at-home orders. And so we were trying to guide them practically. As Nathan mentioned, there's a program in place. Hopefully the kinks have been worked out to a degree, but when this original program was instituted, there were, in our mind, three types of banks you could go to: the large money center banks, national, you have the regional banks, and then you had some of the community banks. And as Nate mentioned, the CDFI expansion of that, I think, really helped some of the smaller borrowers. We found that initially, whether flawed or not, many of the banks that were regional and community based were only working with current borrowers, current clients, given the finite amount that they had available to allocate. And so some of the larger banks took the brunt of a lot of those applications. We did see positive occurrences. We had a couple of our clients that were hotel borrowers actually apply the first day it was available, that Friday, approved within 24 hours and funded within 1 week after that. And that was best case scenario through a community bank. And then we also saw the same results for some of the regional banks. So not to say you shouldn't go through the larger banks, but I did see one article indicating that some of the larger national banks have actually guided borrowers to not apply through them for this additional amount and seek potentially regional and community banks. So it's practically something that I think you need to think about. You don't want to get stuck in a queue as many borrowers did.
Mm-hmm. Yeah, they just kind of anecdotally, I've heard similar things about people being more successful with their applications, in addition to getting application help with smaller regional banks, especially if you don't already have a fairly strong existing relationship with one of the larger banks. And in terms of some of the questions that have come up recently around this program, I think there's a lot of confusion around what it means to need these funds. Borrowers were asked to certify at the beginning that they needed these funds to sustain their operations and to prop up their payroll. But the trick to that is this economic downturn and the virus generally, it's all developing. So you apply for these funds initially and you don't really know to what extent you're going to be impacted. And for some businesses, you don't know for sure that you will be. So providing that certification up front seems to be a little bit tricky. And there's not much guidance around what it means to need the funds, to have them be necessary. And then certification for the forgiveness portion requires that you make kind of a similar certification that you use the funds to retain employees. Well, if you didn't have a reduction in your revenue or much of a reduction in revenue over that time, did you really use it to retain employees? That seems a little hard to say. But again, your application period was at the front of all of this. So if you are a business that was not ordered to immediately drop everything, like a restaurant or a hotel where it's pretty obvious that the impact of the virus would be huge, it's not very easy to know how much of your funds were necessary to begin with, will be forgiven at the end. And then there was an update to the FAQ document that the SBA provided on Friday that mentioned something about if you return your loan in full by May 7th, you'll be deemed to have made that certification about needing the funds in good faith. So that's a little bit of well, what exactly does that mean? And if I still don't know, what do I do? And I think that it's causing a fair bit of uncertainty, at least that's what I'm seeing.
Agreed. And the other part of the certification and whether it's forgivable, I'd say the hotel industry utilized this pretty quickly, just given the nature of what was going on, both hotel owners, operators, the flags themselves. There was significant layoffs at both all of the flags, the Hiltons, the Marriotts, as well as at the underlying hotels. And the challenge is that they may not need those employees back right now. They're still closed for the most part. And so it's been a very difficult process to figure out how this all works itself through in the end. Obviously, Novogradac and other accounting firms are guiding their clients, but we're just guiding folks that, you've got to, notice that most of this is very fluid. You get your applications in, you take the loans, the ones that need the capital to stay afloat, which are quite a few businesses, have been using that. And I'd say they're waiting for further guidance, as was mentioned in the FAQ, as to what is forgivable and what isn't, and whether or not they really want to bring the employees back, because some of these hotels don't have anything for those employees to be doing. And so if they brought them back, they'd be incurring an expense that is unnecessary, given that they also would qualify potentially for unemployment.
Great. Well, that's very useful information. Hopefully, we'll see some clarification of that FAQ 31 and more information and guidance about the back end forgiveness sometime soon here. So, why don't we pivot now to the Main Street Lending Program?
Nate?
Yes.
Real quick before we jump off of that, just a quick question. As questions come about since we're on that topic. A question came in about what are the potential penalties if the SBA determines that a company did not meet the requirements of needing the funds?
Yeah, it becomes a little bit scary. This is not my area of expertise. We have folks here at Baker that are experts in SBA matters and government contracting. We produced an alert that kind of lays out some of those consequences, and as I understand it, in addition to interest and penalties, there are also treble damages, so 3 times the loan amount. So it is pretty severe, and something that has to be considered.
Mm-hmm. Okay, and maybe just before we leave that slide, since again, this is a question pertaining to the existing programs, before we get to the Main Street, there was a question on the EIDL loan process. The question was that EIDL was originally touted as a $2 million, 1% interest, 30-year term, but the indicators are that it's become a $15,000 maximum amount basically being awarded. So do you have any insight on that, the EIDL loans?
Well, the insight that I can provide is that whoever asked that question was correct. There was clear guidance regarding a maximum loan amount of $2 million plus an advance that was essentially a grant that was forgivable. When $10 billion seems like an insane amount of money to folks like me and probably Megan and Anthony that are in the tax credit world. You think about allocations of new markets tax credits and kind of what we eat up and historic tax credits and other things, and $10 billion seems huge, but these are unprecedented times, and folks blew through that initial $10 billion like that. And my guess is that ratcheting down was just a consequence of not enough supply and way too much demand. We'll see what happens with this additional $10 billion that was appropriated and authorized for EIDL. Hopefully, those amounts ratchet back up, but we'll see.
Mm-hmm. Yeah, there was a letter from Nancy Pelosi, Chuck Schumer, and a couple of other people released yesterday to the SBA, Democrat legislators, and the letter indicated that the SBA's move to tie the EIDL advance grant amount to a number of employees, which some people who've applied for this may be familiar with. The SBA decided in administering the program to limit that advance grant amount to $1,000 times your number of employees, limited to $10,000. And the letter that was issued to the SBA took objection to that. So this was meant to be $10,000, not tied to employees. It is just say it's an advance grant to get the money out fast and to get that specific amount out fast. Obviously, that's not binding on the SBA. What these legislators said that they want to happen, but there is some pushback, and we'll see if the SBA decides to change its course as it's administering this next $10 billion of the loans.
And one last point, Yvette, is that we've seen practically that the PPP program had less clarity early on than the EIDL program, and almost all of our borrowers opted not to go the EIDL route and to actually go the PPP route. Just given that the EIDL is, got some components to it that didn't make it prudent to take on more debt, given the economic macro environment that these borrowers were faced with. So the PPP just seemed a lot more appealing, and so we had borrowers apply for EIDL and then move quickly to the PPP and not even pursue the EIDL, which I then understood was very quickly exhausted, and people were shut out, even those that wanted to pursue it.
Great, thanks.
Okay, on to the Main Street Lending Program. So the Main Street Lending Program is a $600 billion fund that is intended to encourage eligible lenders to make new loans or increase existing loans to smaller and mid-sized qualifying businesses. The fund is a special purpose vehicle, or an SPV, that is formed by the Fed, and the way it works is it's capitalized with a $75 billion equity infusion from Treasury, and then the balance is capitalized by the Fed. So the remaining $525 billion to get you to that $600 billion figure. And the idea here is that this special purpose vehicle, this SPV, will work with eligible banks, and the banks will originate and make the loans, but then the SPV participates at a 95% level in those loans. That the bank retains a 5% loan, which is very important because as I understand it, it's kind of a partnership. The Fed is really leaning on banks to do the front end diligence and underwriting and documentation, and having that skin in the game is an important and kind of meaningful way to ensure that the banks are doing all the things that they normally would do. The other thing that I want to point out before we move this slide is, we've had a chance to speak with some folks in DC and some folks from the Brookings Institute, and it's interesting. During the course of the conversation, they must have said 5 or 6 times that the Fed can lend but not spend. And I think the idea here is that the Fed really is not in the business here of losing money, and that infusion of the 75 billion in equity from the Treasury is that buffer that presumably is kind of sized to deal with potential losses on repayments. So kind of interesting the way that the program is structured. Next slide. So the Fed has produced a form term sheet for each of the 2 new programs. So there's the Main Street new loan facility, and then there's the Main Street expanded loan facility. And there's a term sheet for each of those that the Fed has produced. And the idea here is that when banks originate these loans, they've got to conform with those term sheets. And we spent a lot of time looking at those term sheets, and I would say largely they are similar, but they've got some important distinctions, which we'll talk about. The other thing I would point out is that these term sheets that have been produced are not clear on their face. Certainly they require some additional clarification and guidance from the Fed. What we're going to do next is talk about some of the specific terms that are included in those term sheets, and we're going to start with the items that are common to both of the facilities, and then move on to items where there's a difference between the new facilities. The other thing is that the way that the term sheets were introduced was via a press release that happened, I think, on the 9th. And after the 9th, there was a comment period of something like 7 days, and lots of folks submitted comments. I've heard that it's like 2,000 or something like that. And so as we go through these terms, I'm going to note some of the terms that have received a significant amount of comments. So let's advance to the next slide. So maybe the most important term here goes to eligibility. Obviously, this is a program that is geared towards small and medium-sized businesses, and so what they have decided to do as far as definition is to say that in order to be eligible, the borrower has to have no more than 10,000 employees. So there is no minimum, but the cap is 10,000 employees, or its 2019 annual revenue cannot have exceeded $2.5 billion. Importantly is a lot of us that have been focused on the PPP program have found out there are these complicated affiliation rules for purposes of determining headcount. There is no indication that any of those rules apply with respect to this Main Street loan program. So the number kind of is what it is. Next, this is targeted towards U.S. businesses. So specifically, the borrower's got to be created or organized in the U.S. or under the laws of the U.S. with significant operations and a majority of employees based in the U.S. The word significant, as far as significant operations, is not defined. And I know we here at Baker are expecting guidance on what exactly that means. And I know a number of commentators have also raised that issue. And then finally here, lenders. So the lenders that are eligible to participate are U.S. insured depository institutions, U.S. bank holding companies, and U.S. savings and loan holding companies. A number of commenters have noticed and commented that this could be a real problem for borrowers that, for example, bank with a U.S. branch of a foreign bank. Those banks are not eligible, so that's an issue. And then in addition to that, there are a lot of non-bank lenders out there. Think funds and other investment vehicles. Those non-bank, non-traditional lenders are also not eligible to participate, and I know folks have taken offense to that. So we'll see if that moves at all as we get more clarity here. Next slide. So moving on to the loan terms. For each of these facilities, the term is 4 years. And the interest rate is equal, it's a floating rate that is equal to the secured overnight financing rate, or the SOFR, plus a spread of 250 to 400 basis points. So a number of people have kind of focused on this interest rate provision. Is most folks are aware, a number of years ago, there was some sort of rigging scandal by traders related to LIBOR, and I think is a result of that, among other things, LIBOR is being discontinued sometime in 2021. That being said, banks and borrowers are not familiar with SOFR, and I think the comment is that this may be, using this benchmark or index may not be the greatest thing as far as introducing complexity into an already complex program. The other issue that I've heard raised is that rate might just be too high, and there's a lot of pressure to push that down by 100 bps or more. So we'll see if that gets anywhere.
Hey, Nate, real quick before you move on off of that point, and it'll be covered a little bit more in detail in the presentation, whether the spread itself is too high. One of the items oh, I'm sorry. Can you hear me now? Nate? Can you hear now?
Yes.
I can't hear you.
Nathan can't hear me, but Yvette, you can?
And I can as well. Yeah.
Yes.
Okay, great, no problem. So what I was going to get to, and I'll let Nate jump in. So what there isn't listed here, which is very important, is a floor. And we'll highlight that because regardless of whether the spread goes down or not, which would be a good thing, the absence of a floor is a very good thing. And I'll hit on why that is, given what we're seeing from current lenders today and facilities, characteristics that do have that floor concept, given how low rates are, be it SOFR, LIBOR, or the 10-year.
Got it. Final point on this page goes to the minimum loan amount for both facilities. It's $1 million. We've heard a lot of comments objecting that this minimum loan amount is too high, particularly folks that are focused on truly small businesses. And the comment here is that something much lower, closer to 500,000 or even less than that is more appropriate. So we'll see if that gets any legs. Next slide. So now transitioning to certain terms that differ between the new loan facility and the expanded loan facility. Probably the most important one relates to the maximum loan amount. For the Main Street new loan facility, it's a lesser of formulation, and it is the lesser of $25 million or a cap that is based on EBITDA. And specifically, the way this works is that you look at the borrower's 2019 EBITDA, you multiply that by 4, you then subtract out the borrower's outstanding debt, and then you also subtract out committed but undrawn debt, and that delta is the other tier of this lesser of formulation. There is a lot of pushback and commentary on this structure as far as the maximum loan amount. One big comment that folks have raised is that these term sheets do not define EBITDA, and is folks that are in the finance industry are aware, that can vary pretty widely based on what the document says. In addition, a number of folks note that the way that this is maximum loan amount is computed, it really means that there are borrower groups that just won't be able to take advantage of this program. You think about nonprofits, you think about growth or early stage companies. They're just not going to have the EBITDA to support any meaningful loan amount. The other item that I want to point out that we've noticed and others have commented on is there is going to be some real friction as far as dealing with existing lenders. As most of us know, if there are existing credit facilities in place, oftentimes those credit facilities are going to contain covenants that really limit the ability to incur additional debt and things of that nature, which means that any borrower that is looking at one of these new loan facilities is going to have to go back and get consent from current lenders, which in this environment, quite frankly, might not be so easy to do. Pivoting now to the expanded loan facility, similar, but the limits here are higher. Like the new loan facility, this is a lesser of formulation. It's the lesser of 150 million or an EBITDA cap. The difference with the expanded loan facility is that here it's 6 times EBITDA as opposed to 4 times. And then there's a third prong here, which is 30% of the borrower's existing, outstanding, and committed but undrawn bank debt.
So Nate, you got a question on this slide? Do you need to have a positive EBITDA to be eligible?
Well, what's that?
I said, looking at the formula, the lesser of. So the question is, do you need to have a positive EBITDA to?
Yeah, I mean, yes. The way this is currently drafted, you would need a positive number there just because of the lesser of formulation. And again, what this means is that for a lot of the folks that actually need these Main Street loans or facilities, they're just not going to be available. And again, there are a lot of folks that think that EBITDA is not an appropriate measure. Maybe you look at adjusted EBITDA, maybe you look at other indicators like multiples of revenue. I think a large swath of the commenters think that really banks should have more discretion in determining kind of what's appropriate. But to answer your question, as of right now, if a borrower has a zero, then this loan program is probably not going to be available to them. Okay, let's move on to the next slide here. So security, pretty simple. For the new loans, there is no collateral; they are unsecured. With respect to an expanded loan facility, the idea here is that if the borrower's existing credit facility is secured with collateral, then what happens is that the expanded loan facility would be secured by that same collateral on a pari passu basis. So that's how it works, pretty simple. Let's move on. I am running up against my time limit, so I'm actually just going to skip to the last slide here, which is status. As I referenced before, this program was introduced via press release on the 9th. There was a 7-day comment period that ended on the 16th. A lot of people commented, something like 2,000 comments. What we are hearing from our folks in DC is that the Fed is expecting to finalize the program by the end of this week. So synthesize all those comments and make appropriate changes to the term sheets and get this going. We'll see if that actually happens, but that is what we are being told. And with that, I am very anxious to hear what Megan and Anthony have to say on kind of the more practical side of the Main Street programs.
Sure. I mean, I think a lot of the practicalities are going to start playing out once we get additional details around these loans. So questions that I have been getting are, well, how are they determining the interest rate? Because as you mentioned, that spread is a little bit higher than some people are able to just borrow. So it seems like there are some businesses who just aren't going to take advantage of it. And given that this is a 4-year term note, I think the fees play an important part in thinking about this loan as well. So the Fed's special purpose vehicle can purchase a 95% participation in these loans, and on that is a facility fee, which the term sheet says an eligible, this is for the new loans anyway, an eligible lender will pay the special purpose vehicle a facility fee of 100 basis points of the principal amount of the loan participation purchased by the SPV, and the eligible lender may require the eligible borrower to pay this fee. So that's one chunk of change. And then there's also an origination fee of 100 basis points on the principal amount of the loan that an eligible borrower will pay under the terms of the term sheet. So, you know, I think that's really, it could be that this program, unless there's some changes by the end of the week, may not be a really attractive one for some borrowers.
I would agree with that. And more importantly, limiting it to this type of lender is locking out quite a bit of capital on the sidelines that I think would free up some credit for some companies that need it. So Megan, I'll probably let you jump into your presentation just to try to stay on point. I'm going to hit on a couple of the realities of what Nathan said and why 250 to 400 basis point spreads might not seem like such a bad idea given where some of the lenders have gone just in the capital markets that we're seeing.
Okay, yeah, so we can head on to the tax provisions. I'll do a very high overview of this. The devil is always in the details with I think all of these programs, but it's always the case in tax. We can go on, let's jump ahead a couple of slides. Yep, there we are. So there are, you know, I kind of grouped these into four different provisions. There are a couple of payroll tax impacting provisions, and then limitation calculation provisions, AMT credits, and qualified improvement property. So if we can go to the payroll taxes, that next slide. Two pieces to this, and both of these are optional. One is the delay of employer payroll tax payments. One is the employee retention tax credits program. Both of these are alternatives to participation in PPP, but under slightly different wording, which I'm not sure was intentional versus not. So the wording for delay of employer payroll tax payments is that it's not available if PPP loan amounts are forgiven. For the employee retention tax credits, it's not available if you participate in, or rather if you receive funds under payroll protection or paycheck protection program funding. So if you even receive the loan in the first place, it's not an available option. So again, one is forgiven, one is even if you receive the loan. I'm not sure if that was intentional or not. But the idea of these, the delay of employer payroll tax payments is a cash flow kind of idea where an employer's quarterly payments of their share of FICA, the 6.2% of an employee's salary, those can be delayed. The payments that can be delayed are ones attributable to March 27th through December 31st, 2020. They can be delayed in payment with half of that amount that's delayed due December 31st, 2021, the other half due December 31st, 2022. Again, this is not available if your payroll or paycheck protection program amounts are forgiven. The retention tax credits, it's against payroll tax filings and the excess is refundable. And the maximum that anyone can get is $5,000 per employee. And that is the total amount. The up to 5,000 plays off of what qualified wages are per employee. And the qualified wages are limited to $10,000 per employee. So you reach that $5,000 credit amount limit. And eligibility for this is a little bit funny. There's a carrying on a trade or business in 2020 requirement, which is pretty self-explanatory. But then eligible quarters. So you can take advantage of this tax credit in several quarters, but the maximum amount for all quarters for any employee of the credit is the $5,000 of credit. So you either need to have your trade or business fully or partially suspended during that quarter due to a government order related to COVID-19 restrictions on commerce, travel, gathering, or you need to have a significant decline in gross receipts as compared to the same quarter from the previous year. And that significant decline is defined as kind of a 50% reduction is when you can take advantage of this credit initially is the first quarter where there's a 50% reduction as compared to the previous quarter in your receipts. And then you are no longer entitled to the credit beginning any quarter where the reduction of your receipts is 80%, or rather the amount of your receipts is 80% or more as compared to the same quarter of the previous year. And I think a big confusion area for this is the partially suspended language. So what exactly does that mean? It's not operating at normal capacity, and it's not really clear what that means either. So if your business was declared to be a critical business and able to continue functioning, but say you're a supplier to restaurants of ingredients, then you weren't ordered to close, but a lot of your customers were. So does that cover you in terms of having your trade or business fully or partially suspended. And so that's creating a little bit of confusion there. And we can go on to the next slide. So interest and loss limitations. The modification on limitation for business interest is kind of this is another cash flow kind of incentive, such that for 2019 and 2020 tax years, for non-partnership taxpayers, the limitation on the ability to deduct interest expense increases from 30% to 50% of taxable income, again, for 2019 and 2020. And you have the option of using your 2019 taxable income to calculate this, realizing that 2020 may have reduced taxable income. For partnerships, it's the partnerships option to increase the deduction from 30% to 50% in 2020, but in 2020 alone. And again, the partnership can use the adjusted taxable income from 2019. For the partners with respect to 2019, given the kind of the flow through nature of partnerships, 50% of 2019 excess interest for a partner is treated as accrued by the partner in 2020 instead, without any limit to deductibility, with the remaining 20% of any 2019 excess interest suspended until allocations allow the deduction. So allocations of income to that partner allow for the deduction of that interest amount. Then modifications for net operating losses. Generally, this is more or less what the provisions are for both corporations and non-corporations. But the taxable income limitation is in terms of taxable years beginning before January 1st, 2021, that limitation of NOLs is eliminated, so you can fully offset taxable income using NOLs. Again, making this kind of a cash flow kind of item where you'd have those available eventually anyway, but making the NOL available earlier so you can get the tax benefit from it. For 2021 and later, there are some restrictions. Your 2017 carry forwards would be completely available against your income, so you could completely offset your income using those NOL carry forwards. But to the extent you have any carry forwards and carry backs from 2018 and on, those bring back the limitation to 80% of your taxable income less the pre-2018 losses that you apply. So for example, if you had 2021 taxable income of $2 million, 2017 and earlier NOL carry forwards totaled $1.5 million, you can use all of those against your 2021 taxable income, leaving $500,000 left. But then your use of 2018 and later NOLs would be limited to 80% of that remaining $500,000 or $400,000. So we can go to the next slide.
Megan?
Yes.
Megan,
Yes.
just a quick question on the payroll tax deferral. So
Yes.
if you receive forgiveness on a PPP loan, can you defer the employer's share of the payroll taxes until the date of forgiveness?
That's an interesting question that I don't believe has been answered very well yet. The legislation does say it's not available if the amounts are forgiven. So it seems like the reading of that would be that perhaps you can, and then you immediately need to make up the payments if your Paycheck Protection Program loan is forgiven. But it's not wonderfully clear yet on that piece of things.
Thank you.
All right, so these last two little items, alternative minimum tax credits for corporations and qualified improvement property. Tax Cuts and Jobs Act provided a couple of provisions that this is essentially stepping back or correcting. The Tax Cuts and Jobs Act eliminated corporate alternative minimum tax, with the remaining AMT credits, to the extent there are any, available as refundable credits for years ending in 2018 through 2021. The CARES Act says we'll expedite those and have those refundable starting in 2018 or 2019. So spreading over a smaller period of time. Get another cash flow kind of item. Qualified improvement property is yet another cash flow kind of item, and also a correction. So the Tax Cuts and Jobs Act provided that qualified improvement property would be subject to a 39-year life, with qualified improvement property being defined as any improvement made to the interior portion of a building, which is non-residential real property, if placed in service after the date such building was first placed in service. So essentially improvements. The CARES Act now classifies it as 15-year property, which is eligible for bonus depreciation. That's applicable to property placed in service after December 31st, 2017. Then we have a couple of resources in the next several slides. So if you can go to the next slide there. There's SBA.gov, has some resources for people. Treasury.gov. Go to the next one as well. So my firm has, at this IP address, has some resources that we're keeping up to date on COVID-19 as additional pieces of legislation are enacted, and different versions of bills are making their way through. We're posting about those. Onto the next slide. We have a couple of webinars that we've done, and the next slide, as well as a blog and podcast and Twitter account for the firm. So a couple ways to keep yourself up to date while we're posting all these updates. That is everything.
Excellent. Yvette, you can hear me, I take it?
Yes, I can. Go ahead, Anthony.
So as it relates to all of the, the very fluid changes that we are dealing with, and it has been a daily event for us, especially being at, as I mentioned, the epicenter for some borrowers. Megan mentioned restaurants, hospitality. When your business is shut down in effect overnight, you tend to have to triage, pretty quickly what you're going to do and make some hard decisions that candidly are unlike what we saw in the 2008 financial crisis. So if we just want to skip, I want to be cognizant of time. Just skip to the continue forward to the charts. A lot of this information in our deck is redundant. Right there is great. So what are we seeing in the capital markets today? And candidly, if you look at the chart to the left, Nathan talked about LIBOR, we talked about SOFR. You can see the impact of COVID-19 as it relates to interest rates. It was a cliff. It dropped, and as many folks have indicated, in most of the credit markets that we're dealing with, it's going to look like a Nike swoosh. It's not going to be a quick return, and it's going to be, in effect, in our mind, kind of a slow go as it relates to the interest rates that we're currently in unprecedented levels. 10-year treasuries, the LIBOR indice that Nathan mentioned, SOFR is a little bit less than the LIBOR index, but we're talking about 25 basis points to 30 basis points of an indice. So, that's the one part that is what I would say the good. If there is a silver lining, cost of capital is less. The problem that you see on the next chart is where I was indicating, the actual spreads and the concept of a floor. So in 2008, 9, and 10, you can see the spike spreads were, where they were in normal times, somewhere in that 2.5, 2 range. And then back in the 08-09 crisis, we spiked above a 600 basis point spread. And you can see where the circle is, within 1 month, we spiked from normalized spreads to north of 400 basis points. And what we're finding, at least, we broke it down by sector, just because the real estate markets tend to be a little bit quicker to react. And I think what you're going to find out, and I'll kind of finish with that, is how, secure debt, doesn't matter, real estate secure debt or other assets that secure the debt. What is different, other than, unfortunately, the decline in interest rates and obviously the spreads widening, is that the financial institutions, unlike in 2008, 9, and 10, were not financially distressed and actually have significant capital on the sidelines. So I think what you're seeing from this CARES legislation and what will come down from the Main Street Loan Program is how do we protect against what we experienced in the 2008 financial crisis and hopefully learn from that. Unfortunately, as Nathan mentioned with the loans, the spreads seem a little bit high, not compared obviously to the chart that I have to the right. In financial institutions, we have seen, minimum floors of 3.5% to 4% on some of our loans. So if you're a LIBOR-based borrower and your spread is even 400 basis points above a 25 basis point indice, you're probably going to be just at that bottom of the spread. If you were at a normalized spread above a 25 basis point, a lot of borrowers would be, ecstatic to have sub 3% borrowing. Now we have, as this has changed daily, we have been able to actually do some forward swaps and recently locked in, 285 5-year kind of term loans. So there is opportunity, but a lot of the lenders now are really instituting floors. And I would say best case scenario based on the floors we've seen, 3.25% to 3.5% is pretty, is a pretty decent rate. And that's why these Main Street lending programs, as guidance comes out, even if the fees are a little heavy, and hopefully they work on that, I think the rates as compared to just what we're seeing in the capital markets, if you don't have a floor, you're probably in the position to borrow sub 4%, which I think would be worthwhile to consider, just depending on your situation. So we've seen this before. Nathan and I worked on a lot of highly distressed transactions that had a lot of moving components to it with regard to tax credits. The one positive is we've seen lenders behaving very rationally, moving very quickly to help borrowers in this most recent downturn. And actually, we've seen it specific to real estate, CMBS lenders actually making themselves available and being able to get a live person and providing you with some guidance, whereas typically you have a hard time getting any guidance whatsoever in those securitized pools of debt. So I would say there's a lot more details that we're going to need to find out to come, but it shouldn't be surprising that as spreads start to widen and the rates stay at these levels, we're going to need to see some liquidity injected into some of these businesses that need the monies to continue to ramp up through, hopefully, knock on wood, when we can get back to normal. Everything else, just I know that Yvette, you said that this would be posted onto the GCP website. I'm the real estate capital markets MD, but we have multiple verticals within the firm: consumer, healthcare, diversified industrials, environmental and industrial services, metals, and business services. So one of the benefits I think we're going to have next webinar is we're going to receive guidance from all of those verticals as to how the C&I lending markets are behaving. And a lot of these other MDs within Brown Gibbons are actually approaching my team to find ways to monetize real estate that typically mid-market businesses have not done historically, but are finding it necessary to monetize or get some facilities on the real estate that they have in lieu of uncertainty on the Main Street program. So we hope to add industry-specific guidance on the next webinar.
Great, thanks, Anthony.
No.
So if folks have any questions, if they would like to send them in now, we'll take a few more questions. I've got one around PPP, and I have one around the Main Street Lending Program. So the first one is regarding the PPP loan. Has there been any indication of penalties being imposed if less than 75% is used for payroll?
The requirement for payroll is that 75% of the forgiven amount needs to be made for payments to employees. I think, again, this is an area that's not wonderfully clear. I think that there should be forgiveness given for that piece, and then, to the extent that you have borrowed in excess of that, there's an ability to pay it back. So kind of taking that ability provided statutorily to be able to pay it back, and then the 75% expenditure on payroll amount needing to be that amount of your forgiveness. I think those two can be taken together. I've seen concern around that, about people thinking that well maybe the 75% is supposed to be the loan amount. My view is that that's the forgiveness amount, and then you have to repay to the extent that your numbers don't fit that amount. Any thoughts from Nate or Anthony?
No, I think that's generally right. Two totally different concepts: permitted uses and reductions in forgiveness amount. The 75% was a surprise because it's not consistent with the statute, and it's just impacts forgiveness but doesn't go to permitted use.
Mm-hmm.
So then on a question on the Main Street Lending Program, Nate, I know you mentioned this was a program run through the Federal Reserve and they don't have the ability to expend dollars, but just to be clear, the question was, did the Main Street Lending programs need to be repaid? Is there any type of forgiveness like the PPP?
There is not, no. And just to be clear, what I meant was, the Fed is not kind of in the business of making grants or giving conditional loans. So, when it makes loans, those loans need to be repaid. I mean, that's taxpayer money at the end of the day. And the point that I was trying to make is that, that's where this equity infusion from Treasury comes in. Everybody knows that they're going to take L's on some of these loans. And that buffer, that the equity from Treasury is kind of what should give the Fed comfort that it can deploy money and not lose money in excess of that cushion.
Got it. Okay, just a reminder, if anyone has questions, they could submit them now. I have one more question on a defined term for the Main Street Lending Program. I believe this was back on slide 10, if I recall, as part of your calculation, Nathan. The question is, could you please define what is meant by outstanding and committed but undrawn debt?
Anthony, you take that one. You're the credit.
Well, I think lawyers are big on defined terms, but I think what they're trying to get at, and this is where, for the mid-sized company that might either have a financial owner that utilize leverage both through a term facility and then potentially has an undrawn revolver, why the EBITDA metric is so important to have some defined terms around that, because as the question is probably getting to the heart, is if you have not drawn but have available to you on your revolver dollars, you may get penalized for not utilizing those and be unable to qualify. That's why Nathan mentioned earlier, you're going to want to try to have some form of an adjustment on the EBITDA, as well as some clarity around the fact that everyone, you don't want, as we've seen, some very large corporations have drawn, Hilton and Marriott in particular, they drew on their lines of credit for fear that they may not be able to at some point in the future. So the idea here is to try, where a lot of the comments came from, is to try to not penalize for a revolver that hasn't been drawn.
This might be somewhat of a related question, but again, on the Main Street Lending Program, there's a question about what are your thoughts, if you have what are your thoughts on the rationale for including real estate debt in the calculation?
What the rationale for including real estate debt? I guess I'm not sure if that question means, is it applicable to real estate, or why is debt that is secured by real estate kind of a component of the equation? What I would say is, again, this all goes back to the fact that unlike PPP, the Main Street loan program, this facility, they are loans that have to be repaid. The Fed is a lender of last resort. It's a credit facility that's available to businesses that cannot borrow anywhere else. The reason that secured debt, for example, is included in the computation, it goes to the ability to repay the debt. If a borrower is already insanely leveraged, then layering more debt onto that borrower, particularly during a time like this, really means that there's very little practical ability to kind of repay that debt that is owed to the Treasury. With respect to the other kind of spin on the question, as far as, is the Main Street lending program going to be a program that folks in the real estate business can use? The answer there is I don't know. I mean, but first of all, I would say that real estate businesses, sometimes they don't have a whole lot of employees. While there is no minimum as far as the number of employees, clearly based on those certifications, there's some kind of intent that these loans kind of go to stabilizing the job market. The other issue is, all of these limitations on using Main Street facilities to kind of repay existing lines or letters of credit. If that wasn't precluded, then this would clearly open in some doors in the real estate industry. But because of that, it just makes me think that, look, never say never. I'm sure there are situations where real estate type entities will be able to use Main Street. I just don't think that'll be the bulk of the borrowers. I think it'll be more, industrial manufacturing, what you traditionally think of as a middle market company. Just my opinion, though.
This one might be Anthony. I know you talked a little bit about hotels. This is a question. If the maximum loan amount, this is again Main Street, if the maximum loan amount is 4 times EBITDA, including real estate debt, how would a hotel meet this requirement?
So that, the reality, the PPP program was the first, what I consider to be actionable relief package for the hotel borrower, owner, operator that is much more in the real estate world like an operating business, and a lot less with the characteristics of just a real estate owner of other types of real estate. So I think, and it's a much broader kind of concept, and I talked a lot about the 2008 financial crisis, and I think what's important to note, it's back in 2008 they formed something that came out of this Main Street lending program announcement on the 9th, is the term asset-backed securities loan facilities, are these TALF facilities, because what the CARES Act and the PPP and the EIDL did not do is address the fact that many borrowers in securitized products that are not conventional lenders, be it regional, community, or the other, they might have collateralized mortgage-backed security lenders, CMBS lenders. There has been no backstop whatsoever to those loans, and there was an actual when reporting came through for roughly, I think it was 40% of those loans, those borrowers for the hotel in particular, when the reporting came in, they said that at least a third were already in default. And so what we see happening for the Main Street lending program is, and they've already mentioned this and referred to these TALF programs, is a way for those current lenders to not only allow for the approval of this Main Street loan program, because Nathan mentioned you have to go back to your lenders to get consent and to get approval. And in many instances, they're inundated right now with forbearance requests. So we see the Main Street lending program, and kind of a derivative to that is something like the TALF provisions that were used in 2008 to help existing, in particular, hotel borrowers borrow more, get the approvals to borrow more, and do it in a way that that does not do any harm or disrupt their current lending structure.
Okay, we are just coming up on the 4:15 time frame, and we were expecting to go to about 4:15. So I'm just going to let folks know. I'll ask I have one or two more questions on the PPP that I'll ask our panelists, but I'll just let folks know if they have additional questions or want to reach out. We have a website. You can contact, again, any one of our panelists here today. I think they gave you their information. But we also have a GCPingear.com website that you could go to for additional information, and also chat with one of our folks at the GCP. So just a couple more questions on PPP, and then I think we'll wrap it up. There was a question on if there are some final rules that are coming out. Is anybody aware? I know there were some FAQs that came out late last week, but is there any other guidance that's expected to come out, or is everything that was expected to come out today?
No, I will say that, from my perspective, we do expect additional guidance. So, we've got a lot of different guidance out there. We've obviously got the statute. We've got a number of FAQs that are being produced by the SBA and Treasury, and those are being updated, almost on a daily basis. We've got another set of FAQs that the IRS is maintaining. We've got forms, and then we've got, I think, 4 sets of interim rules. So there is a lot of guidance out there, and it seems to me that all of the guidance that we have seen thus far has really appropriately been focused on the front end. And what I mean by that is, things like eligibility and the affiliation rules and things of that nature. What we expect is that this next tranche of guidance will really go to the forgiveness issue. Everyone is concerned about this. Everyone is curious about this. And I think that's the next big tranche of guidance that we will see.
Okay, and then just one last question. This is back to the Main Street program. The question is, do you see any benefit for non-for-profits to apply for the Main Street lending program? It's got a different type of balance sheet, so it doesn't have the traditional EBITDA. So what are your thoughts on nonprofits and the Main Street lending program?
Yeah, I guess I will take a shot here. So is we kind of, or as I mentioned when we were going through that slide that goes to maximum loan amount, just because of the way that the formula works, I think it will be difficult for nonprofits to take advantage of this under its current structure. That being said, in my mind at least, it's clear that the Fed and the Treasury and Congress expected that this program would in fact be available to nonprofits. So we're hopeful that they are able to kind of review those comments and make some tweaks, let's say, to that definition of maximum loan amount, so that the nonprofit folks will in fact be able to take advantage of these facilities.
Great. Does anyone, any of our panelists have any final comments before we wrap things up? So then I'll just remind folks again, we really appreciate you joining us today. If you have any additional questions or thoughts that you'd like to share with us, please contact us through the gcpingear.com website. And then I'd really like to thank Megan, Nathan, and Anthony for providing such great information for us today. And I want to thank you all for participating. So this will be ending the webinar. Thanks everybody for joining us.
Thank you very much.
Thanks.